This session we are going to cover about sovereign rating. When we talk about sovereign rating, it's the rating of the entire country, right? These are the topic of discussions today. What we are going to discuss is what do you understand by sovereign rating? We'll touch definition. We will touch the importance of sovereign credit ratings. And then we will discuss about the determinants used in evaluation of sovereign rating. We'll touch the qualitative and quantitative approach, and we will show you sovereign rating for a few countries, different scores to measure sovereign credit rating, and credit rating description, and then we will go to a case study. Okay. No, there is. So what do you understand by sovereign rating? So when we say sovereign rating, we mean that it's a credit rating or the assessment of credit worthiness of a country or sovereign entity. It is provided by credit rating agencies like Standard and Poor, Moody's, Fitch Rating, etc. These rating agencies evaluate the financial and economic stability of a country and assign a rating based on their analysis, right? So these are the typical rating scales. I can try to zoom a bit so that you guys can see. These are the typical sovereign credit rating scale. Importance of sovereign credit rating. Sovereign credit ratings are important for few reasons. One is borrowing cost for the country. Another is investor confidence. Third one is access to international market. Fourth one is economic policy and evaluation. And fifth one is risk management. Now, when we talk about borrowing cost, what do we mean? Why it is important to have a low borrowing cost for a country? Because we know that India also borrows money, right? India borrows money from IMF, from other countries. So if the borrowing cost is less, why do we need to borrow money? Because we need to borrow money to develop our own infrastructure, healthcare, and other things. So if the borrowing cost is low, it is good for us, right? We end up paying a lesser amount of interest. Second thing, when the rating is good, when the sovereign rating is good, obviously better rating means borrowing cost will be less. So for an example, if your CIBIL score is 750 plus, you will get a loan at a later rate of interest. What is later rate of interest? It is borrowing cost, right? Similarly, my score is say around 650. I'll have to go to a third class NBFC and take a loan from them with a rate of interest of say 18%, 19%, 20%. So my cost of borrowing will be more, right? Similar thing for the country, right? And the cost of borrowing shows how much you're paying. So this is a big thing. Anand, what you are saying, per capita income and tax collection are good, country will never get a good rating, right? Now I understand, but what is per capita income? What is per capita income? Just for a layman, you tell me. I am asking you as a layman. I don't understand about economics. Say, what is per capita income? Huh, that is true. But how do you find it out? Mathematically, how do you find it out? How do you find it out mathematically? But how do you find it out? Give me the formula. Give me the formula. Now I'm giving you a scenario for an example, right? Mr. A, annual income 10 crore. And Mr. B, who is a rickshaw puller, his annual income is say around 2 lakhs, right? Now, when you average it out, do you think this is giving you a correct per capita income? Both are outliers. This is the major problem when you say per capita income, right? There are a lot of outliers. You cannot. So when you do this, this is a problem. Total country income by total population of country. Because Adani, Ambani, like people, they take most of the income. They have very high income. And then the another segment of the outlier is, right, is people staying in slums, people staying in rural belt, people who are below poverty line. Then the term per capita income is not a correct term. It's not a correct term. When you say per capita income, right, there has to be a minimum threshold that a person having an earning of this much amount at least, right? Or at least a basic amount, you know, this is the basic amount which everybody should be earning. It's not that the total income divided by the population. Next, what is the consistency of the income, right? You ideally should consider all these things. So borrowing cost is important, for which sovereign credit rating is a determinant for a borrowing cost. Next is investor confidence. Now, role of foreign institutional investors in your stock market plays a vital factor for your growth, right? Is it correct? Does role of FIIs plays very important in the growth of your country? Okay. Now the point, yeah, FDI also, foreign direct investment is also. Now, when you are going to invest in a bond, say you are a retail investor, when you are going to invest in a bond, you will invest in a bond only when the bond is rated well. You will invest in a bond only when the bond is rated well. Similarly, a country will invest in a country which has got a good sovereign credit rating. Correct me if I'm wrong. Yeah, there are other factors, but normally, how do you judge each and in every factors? Can you judge every factor? So when you get a good sovereign rating, it is a consolidated consideration of everything, Anand. Right? So investor confidence is another factor which is determined by sovereign rating. Next is access to international market. So when you have got a good sovereign rating, you have access to international market, right? They can issue bonds and debt instruments at favorable terms, attracting broader range of investors. This enables government to diversify their funding sources and raise capital for various projects and initiatives. So you are not confined to a single country for accessing to international fund. When you have a good sovereign rating, you can go to multiple countries, right? Economic policy evaluation. Credit rating provides an independent assessment of a country's economic policy, economic financial stability. They'll be useful for evaluating a government's economic policies, fiscal discipline, and overall governance. Right? Rating agencies analyze factors such as economic growth, debt levels, fiscal deficits, political stability. Yeah. Country with high sovereign ratings attract debt market, but not necessarily equity markets. Okay. How come? Can you please explain? I would like to unmute you. Who is this? Anand, right? Okay.
Yes, sir. Can you hear me?
I can.
Yeah. See, what I actually mean to say is, like, if, I'm sure most of us will be aware, if you look at India, the the sovereign rating is not very high. If you look at it, the debt market, hardly there are any kind of global investors. Right? Countries doing everything. They're planning to do it in Europe or whatever it is, and still not right. But if you look at what I mean to say is, when you look at equity markets, only countries which are growing countries, underdeveloped and becoming developed, they can only give you high growth rates in terms of organizations. Right? A matured market, except for scenario like AI pushing Nvidia and
Come
other
again,
things.
just a moment. I just missed your point. Come again.
Yeah. See, what I mean to say is a country which is trying to become like India from underdeveloped into a developed market. This is where you get very high growth in terms of companies' prospects. Whereas in the case of a matured market, they already undergone maturity. So the growth rate will be more like, moderate, 5 to 8% or something like that. Even that itself will be a very big thing. So that's why equity markets in an underdeveloped to a developed transitioning country like India will always give you higher returns. Whereas countries where Europe or Japan or US, already developed, they'll only get 5 to 8%, growth. That is why even their inflation also has been very, very less. Countries like us, inflation is also very high because the demand for commodities and materials are also very high. So that's why growing markets is good for equity. A grown, like if you see US, even RBI puts money in US bonds. Okay, every country puts money in US bonds, though the returns are not much because there is no risk and it's a matured market. There is no risk premium. Okay, whereas in India, if you look, there is a lot of risk premium. But in equity, even though risk premium is there, the returns are much, much higher than the risk premium. That's why our return expectation is 15%. Whereas in US, the return expectation is very less because the risk premium is also very less. That's what I mean to say. Am I right, sir?
Yes, you are right. Now, in this aspect, I'd like to say you one thing.
Okay, sir.
How do you categorize equities? How do we categorize blue chip companies and penny stocks?
Okay, see, when you say again blue chip based on top market cap, if I'm right, that is how the classification is.
So the stable companies like Infosys, TCS, HDFC, ICICI.
Yeah, the stable companies on the basis of the market cap. Yes.
What is the average return of blue chip company shares?
See, on an average return over a period of 3 to 5 years, they should give a something around 12 to 15% is good.
Maximum. Maximum.
Yeah, 12 to 15%.
15% is maximum return.
Correct.
Right? 12% is something which we can assume on a
Assume.
safer way.
Correct.
10 to 12% is something. Right?
Correct.
Now, had it been a penny stock,
Okay. Mid cap, small cap.
small cap or penny stock even, right?
Okay.
It can give you 30% return, yes or no? It can.
Yeah, multi-bagger. It can go multi-bagger.
Multi-bag, right?
Yes.
Similarly, it can be delisted at any point of time.
Correct.
So why they are giving 30% return?
See, actually, they have to give much more.
Correct.
See,
That is the thing. It's
yeah,
a risk.
see, yeah.
It is a set-off between risk and rewards.
Correct.
It's very simple. Now, similarly, when we talk about sovereign rating for a developed country like US or UK,
Correct.
and your return to attract investors in a country like India, there are a lot of things which India needs to provide to
Correct.
the FIIs.
Correct.
When it comes to debt, so what happens? There are multiple things. Beyond the level, you cannot take debt.
Yes, GDP
Right?
ratio or something like that will be
So
the
you have to, yes, correct. So you have to keep a balance on the leverage. You have to keep a balance on your debt and equity.
Correct.
Right. Now, obviously, equity is that way extremely, what do you say, like, attractive, because the risk of equity is borne by the investors.
Yes.
Right. Debt is something where there is a commitment from the country.
Correct.
Right. So naturally, if you see the institutional investors or the qualified investors from the US, UK, they keep on investing in the markets like India or even the developing countries.
Correct.
Okay. Because one, their return is comparatively higher compared to the US and UK.
Yes, matured markets.
Right.
Yes.
But the risk is, only thing is that if they sucks out all their money from the market.
Correct.
Then for the country, the equity market is totally gets distorted.
Correct.
Right. So what you are saying in terms of rating, access to international, now tell me one scenario.
Okay.
India considering is having a stable rating, right?
Okay.
For an example.
Okay.
Right. Country like Syria, country like, what do I say?
Lebanon, Egypt.
Lebanon might be ready to give a high rate of return.
Correct.
Will these qualified investors invest in those countries?
No, in fact, they're not investing in India also. Actually, the debt investments is, if you see, FIs, they don't put money into debt market.
Forget about debt and equity. I'm just talking about the general term
Yeah.
investment. It could be in the form of equity or in the form of debt.
Okay.
Will that investor go and invest in Syria, Lebanon?
Okay. Okay. Because the country rating is very bad, they will not step in.
Correct. So their sovereign rating plays an important role. So when you underwrite a company, when we see the rating rationale, if it has got a rating done, so I know that already a 360-degree appraisal or analysis is being done by qualified analysts.
Okay.
So I'm on a safer bet. So even when you invest in a bond, which is AAA rated, you know that the bond is AAA rated by X rating agency.
Okay.
That means a thorough appraisal of the company, thorough appraisal of the project, cash flow, discounting, everything is being taken care of, and also the intervening variables, which can affect the cash flow, is being taken care of during the rating.
True, but only point is, see, okay, well, based on the country rating as per you, they are investing into equities.
No, I am saying that is one part.
One factor. Okay.
See, one part. It depends on international relations as well.
Okay.
So today the Indian Prime Minister is maintaining cordial relationship with almost all the countries.
Correct.
And scenario is quite changed. If you see, For the last 2 years, how many attacks have been done from other countries?
On
And compared to previous years,
okay, it's more stable. Okay.
it's more stable. So there are a lot of factors which are there. Like it can be international relationship, sovereign rating is one part. Now, since we are talking about sovereign rating, yes, this is one of the determinant for getting money for a country. Be it in the form of equity, be it in the form of debt. But yes, because India is a developing country or might be another country, could be a developing country, where equity market is more, more attractive compared to the debt market.
Yes, equity market is definitely more attractive to debt, and
That has to be.
Yeah.
That has to be. That has to be. And if you see the equity market monitoring in compared to London Stock Exchange, and if you compare it with Bombay Stock Exchange, the monitoring and level of manipulation degree differs a lot.
Surveillance.
Differs a lot, and that is intentionally done.
Okay. So I'm saying like surveillance is better in India.
Surveillance is better in obviously London Stock Exchange.
Oh.
Much better. Okay.
Okay. Noted. Thanks.
Next is risk management. Obviously, credit rating assists investors and financial institutions in managing risk. Okay, there are 3 messages. Let me have a look. That is why in credit risk, the parent country of the risk for an account CP is very important and captured, even if the present CP is counterparty risk. Okay, captured even if the present in many countries. This aligns with sovereign credit rating. Correct. Right, Praveen. Correct, Praveen. You are right. So credit rating assists investors in financial institution in managing risk. Obviously, because when you invest in a bond as a retail investor, you look at the rating of the bond. Similarly, when there will be thousands of crores are infused into a country, obviously the investor will look into the sovereign rating. These are some typical determinants which are used in evaluation of sovereign rating. One is economic indicators, fiscal performance, external position, political and institutional factors, access to capital markets, socioeconomic factors, and geopolitical risk. So I will in fact elaborately discuss on each and every factor. So in these approaches, I'm going to discuss all these factors. So there are 2 approaches of sovereign rating. One is quantitative approach, another is qualitative approach. So when we talk about quantitative approach, it means economic indicators. So when we talk about economic indicators, it means GDP growth, inflation rate, unemployment rate, fiscal deficit, current account balance, debt to GDP ratio are analyzed to gauge the economic health and stability of a country. Honestly speaking, I don't have a model for sovereign rating. Otherwise, I could have shown it to you, because those are highly confidential sovereign rating models. I don't know anybody who has. Praveen, by any chance, you are having a sovereign rating model and scales? That what is the benchmark and all these things? Yeah, it's quite confidential. That is what I said. Like, might be you are having, that too also is given by your company, which even like you cannot change it, you cannot take it away. Like you cannot take it out of your office laptop. Correct. So it's very much confidential. It cannot be taken out. So in the open source, it is not available. Right. So so only thing is that we can talk about the parameters, but when it talks about the benchmark, we won't be able to share the benchmark. because it's confidential, doesn't come out, right? Next one is financial metrics. Financial data related to government revenues, how much revenue the government is earning in terms of tax. So why there is a push for tax all of a sudden? So the moment Modi came in 2014, he has been pushing for tax though, GST though, everything, because it increases the government revenues. Next is expenditures. So at beyond the point of time, you cannot have a control on the expenditure, but definitely you can take tax, right, to increase your revenue. Budgetary policies, debt dynamics, all these are assets. Factors like revenue diversification, government debt affordability, interest payment coverage ratio, debt maturity profile. Now, let me ask you one thing. What is revenue diversification? What is meant by revenue diversification? What is revenue diversification? Multiple sources of revenue. Correct. So when we talk about multiple sources of revenue, what it could be for a country? Exports. Very good. Next. Manufacturing, tax collected from manufacturing. Direct tax and indirect tax, right? Industrial, not just commodities like, okay. Next. Okay. What about income from, correct. I was just going to type this, income from global investments. Income from global investments. And why global? Make it generic. Income from investments. Right? An important factor. Yes, no. RBI gets dividend from PSUs and pays government. Correct. Now, the next one is historical performance and pattern. So when I talk about historical performance and pattern, just close this. I'll open a different Excel. So whatever, whether it is paid directly or indirectly, doesn't matter, but it goes to government, right? Now, say for an example, year 1, year 2, year 3, and last financial year. You get the data of revenue, you get expense, the major thing, right? And other key important financial parameters. So first you see a trend, right? Say for an example, arbitrary numbers 10, 12, 13, and 15, right? You see what is the trend, right? Fair enough, Tanumai Kunal, I understand, but what we are talking about the income for government of India, be it coming through RBI or not, let us ignore that part. I understand. Let us understand that what is the income or revenue for government of India and how it is relevant for sovereign rating, right? So you can see a trend, right? you can see a trend. Also, you can see there is at a certain rate increased from year 1 to year 2. And then in the year 3, there was a slight decline, though there was the growth was there, but the rate of growth was slightly declined. And then again, there was an increase in the rate of growth. So this is the overall revenue analysis you are doing. Now, suppose you split the revenue into tax, right, into income from investment, okay, and other. And then say tax, you are getting around 8, 9, 7, 6 is 2, 2, 2, 2, right? 10. Here it is 0. Here it is 1. Here it is 4. Here it is 7. Right? What do you understand from this figure? These are for these years, right? These are for these years. If I am supposed to put these figures in a graph, what do I get? Correct. So this is how the graph looks like. So when we talk about series 1, series 2, series 3, so ideally I should have taken it like this, and then now I draw the graph. Now you see how the graph looks like. This is tax, this is income from investment, and this is other. So your other income is growing like anything, and your tax income is coming down like anything, whereas your income from investment is fixed. See, it's coming like this, right? Now, tell me one thing. When you suppose you are doing sovereign rating of a country and you see this kind of scenario, is it a good scenario? It's absolutely a bad scenario, right? It's absolutely a bad scenario. Your revenue, which is supposed to come from, most of the revenues which is supposed to come from tax, is significantly coming down. So not only why consumption going down. So I'm talking about both direct and indirect tax. It could be income going down, and as a result, consumption going down. So there is a decrease in indirect and direct tax both. Could be a situation. It could be a situation, right? Yeah. So we need to analyze. Could be a mild recession. That can also be a situation, right? So all these things matters a lot when we do quantitative analysis, and this historical performance is extremely important. Fiscal indicators. When we talk about fiscal indicators, yeah, could be Pakistan selling Karachi port to UAE as other income. Yes, could be. But should it be the primary source of income for Pakistan? It should not be, right? Should not be the primary source of income for a country. Okay. Well, guys, let's start fiscal indicators. Now, when we talk about fiscal indicators, there could be three important things. One is budget deficit, revenue and expenditure consumption, tax revenue as a percentage of GDP. Now, what do we call as budget deficit? What is budget deficit? It is written there, but what could be the cause of budget deficit? What could be the cause of budget deficit? Extra expenditure, I understand. Correct. Freebies, very important. Freebies is extremely important, which we should mention. Lack of revenue, but lot of freebies. So what do you say about Delhi government distributing electricity free of cost? Delhi government distributing free electricity, right? A lot of freebies given by. Good one. Great. We'll feel the heat later on. Obviously, it will create deficit on government exchange, right? So this is something which is extremely important. Institution, oh, sorry. So budget deficit. Next is revenue and expenditure composition is again, to some extent similar to what we were talking about, where you are getting your revenue and what is your expense and what is the difference, what is the gap. Tax revenue as a percentage of GDP, it has to be a significant percentage of GDP. Again, I told you that sovereign rating parameters are not there, not available in the open source. So if you ask me a benchmark that what should be ideal tax revenue as a percentage of GDP, so I'm not the right person probably. Okay. Praveen, can you give us a range at least? What could be the tax revenue as a percentage of GDP? For me, it is 8 to 10%. So what could be the approx tax revenue as a percentage of GDP? What is an ideal scenario? Okay. Praveen is saying sorry. Okay. Could be very secret actually, the benchmark. And no. It could be integrity issue. Don't worry. Do not force someone. It could be an integrity issue for him. No. Okay, fair enough. Next is external sector indicators like current account balance, evaluating countries' trade balance and ability to generate foreign currency. So as we know, like from our school days or college days, whenever we started studying economics, the more the export is, better it is for the country. Foreign exchange reserves is something which is very much important. Forex reserves, we call it in the colloquial language. Adequate reserves has to be there and exchange rate has to be stable enough. So, Forex, it's not that today dollar is 78 and tomorrow dollar is 88. Then again on the day after the dollar is 92. Then again, after one day, it is coming to 72. So there is tremendous, ups and downs. So, okay, fair enough with a 5%, with a 1% or 2% change in the rate. But if the Forex market is too much volatile, then it is going to affect your business. Now, how it is going to affect your business? Say you are an exporter or importer. What if the exchange rate is not stable? How it is going to impact you? Suppose I'm an importer, how the exchange rate is going to affect me? And how it is going to affect for an exporter? So correct. So depreciation is bad for an importer, but it is good for an exporter. Purchase price will fluctuate. Correct. And the mitigate is hedging. You do hedge. The mitigate is you do hedging. Yeah, Praveen. Importer needs to pay more, but exporter is heydays for the exporters. Correct. Next is financial sector stability. So when we talk about financial sector stability, the first thing which we say is what is the non-performing loans of the bank. So it is not a specific banks, what is the country's NPA. So when we talk about country's NPA, then obviously it is an indicator about my overall economic performance in quantitative terms, right? So currently in 23, it is around 3.8%. Right? A regulatory framework and capital adequacy ratio are important factors which we consider for sovereign rating, especially in the quantitative aspects. So when we talk about sovereign credit spread, it is nothing but analyzing the yield spread between a country's sovereign bonds and benchmark bonds, such as US Treasury bonds. So what is my country's bonds and what is the US Treasury bonds? We do a comparative analysis, and spread can indicate perceptions of the credit risk and investor confidence in the country's ability to repay its debt, right? Next is what are the qualitative aspects? So the first point in qualitative approach is institutional factors. So how about the company's political and legal institutions, including governance, transparency, and the rule of law is evaluated? So again, the same question, if a country is politically unstable, if the legal system is not in proper, right, then obviously your sovereign rating would be low, and probably it is not a safe bet to invest in that country. And no FDI like Pakistan, yeah. So there are countries whose condition is more serious than Pakistan. All right. Policy environment, the overall country's policy framework, including monetary policy, fiscal policy, regulatory environment, also are important factors. Yeah, Kamlesh, that is applicable for the states also. But since we are talking about sovereign rating, generally we do not rate a state, don't give a sovereign rating to the state. Obviously, like for there are certain states in India probably which are quite risky for investment. And also there are historical trends which shows that. Okay. External factors means external shocks, commodity price volatility, and exposure to industry. All right. So how the external factors affects the country. So it could be external shocks or commodity price volatility, and how the sensitivity is. What is the sensitivity to that? Social and demographic factor is an important factor like education levels. So when you talk about a country like Kenya, or a country like, Syria, there probably the education level, human development, sanitation, social stability uh, are quite less compared to any countries which are quite developed, right? So naturally, when you give sovereign rating to those countries, so why we do call it is the developing nations because it is not yet developed, right? Combining both approaches allows credit rating and investors to gain a more comprehensive understanding of the sovereign's credit worthiness. So this is quite similar to when we had talked about the analysis of a person as an individual or analysis of a company. So there are multiple factors which we consider. One is the numerical or the quantitative approach, where we look at the financials of a company, we look at the bureau score, we look at the financials, GST, bank statement, ITR, these, that, all these things. And also we look at the qualitative factor, how long the company is into the business, right? How the company is being perceived. Certain factors which you cannot convert it to quantitative, might be you can give a scale to it, but how it is being perceived, or what is the relation between the promoters, how is the relation between the promoters, and who is the key stakeholder, right? What his background is. So all these are qualitative factors as you assess when you assess a company. And similar thing is that when you assess a country, you assess all these, both the quantitative as well as qualitative factors. Yeah. Last two important points are monetary policy and central bank independence. Just quickly go through this. I'll be back in 1 minute. Hi guys, I'm back. So when we talk about correct, that is the thing I was going to ask you. Let me understand, what do you mean by central bank's independence in formulating strategy? Who is the central bank in India? Correct. Has RBI freedom to use the monetary policy, or it is controlled by any particular political party? Let us not get into those political things, but is it that there is a situation where government wants, or RBI wants to take a decision which is getting influenced by few, and RBI had to change the decision? So this is one important factor when monetary policy and other necessary policies of central bank can be implemented successfully. Yeah, to some extent, in every country it is getting influenced, but to what extent it is getting influenced is something is very, very important. And in sovereign rating, all this information comes out, that what exactly happened, what was the initial strategy of RBI, and how it was, distorted, and how it has been implemented, right? So that is extremely important factor. Yeah, RBI has inflation target and changes monetary policy on rates and monetary supply. But what we are saying, how much independent RBI is, and not only RBI, it can be any central bank of any country, how much independent they are to take a decision. That is also an important factor, a qualitative factor of sovereign rating. And last but not the least is the geopolitical risk, which includes terrorist, regional conflicts, potential threats to stability. Analyzing the impact of these geopolitical risks, say for an example, what is happening in Manipur uh, can be an instance to, a situational analysis if done, then do you, considering the current situation, do you really feel interested to go and invest in Manipur? Yeah, so Raghuram Rajan quit because of that, because he was getting influenced. That is what is being heard of. But again, then let us not get into the political things. Okay, so he's a quite qualified person, and he doesn't want to come under the influence of anyone. So that is the reason for which he had quit. So that happens, like that keeps on happening. Now, the point is that we are in the next point. Now, we are not in the central bank independence. Now, when we talk about geopolitical risk, considering the case of, for an example, let us take the example of a state like Manipur, what has been happening. Will any entrepreneur go and invest money in Manipur right now? Correct. So similarly, when there is too much threats, when there was too much terrorism, suppose there is too much terrorist activity in Kashmir, it's very difficult for an industry based in Kashmir to attract a foreign direct investment, or to get even a private equity or a venture capital from a person who is sitting in a country outside India. Or if there are too much of political instability because of whatsoever reason, then obviously this is a geopolitical risk which is posing a threat for the investors, and that is definitely going to affect the sovereign rating of a country. Border disputes, yes, absolutely. Border disputes, Northeastern China disputes. Okay. This is an open source availability. Correct. So US is investing in India and coming out of China. There could be multiple reasons. So could be it's a strategic decision, could be it is an international relationship, and could be because of the recent COVID issue, where China has this, like the Bangladesh and Bengal India border, it is peaceful. Okay, I didn't know that actually. Okay, understood. Yeah. So this is an open source availability for ratings of different countries. Just have a quick look. Could be an old one. Different scores to measure sovereign credit rating: political score, macroeconomic score, external finance score, fiscal scores. Acha, does acha, anyway, you are going to get the PPTs on the. So these are the typical rating scales applicable for countries for different rating agencies. So sovereign rating will not continue for much. Probably we'll end up this session. It's not too long, because honestly speaking, the data and benchmark are not available in the open source. These are some credit rating descriptions again, which is investment grade and which is speculative grade as per the scales. Right? Okay. Okay. Now let us do a small activity. Let us try to design a rating scale, sovereign rating scale. Rating scale, just an abstract one for a country, where I put quantitative factors, right? And we can do it jointly. economic index. So what are the items should I put in the rating scale in the quantitative? GDP growth rate. Kindly write in the chat box. What are the things I should put here? So if I am supposed to make a scale. Let us make a scale. So tax collection, okay. Can I name it as revenue or tax collection revenue? Tax collection revenue. Let us split that. No, we are into the quantitative one. So tax collection revenue. What are the other revenues could it be? Let us go one by one. No, literacy is the qualitative one. Could be income from investment, right? What else could it be? Other income. Okay, fair enough. Next is inflation rate. Inflation rate. Yeah, I'm coming to current account deficit as well. I'll come to current account deficits. So inflation rate. Next is unemployment rate. Next is current account deficit. Sorry, fiscal deficit and current account deficit. Current account deficit, let us name it as CAD. Right? So these are economic indicators. Then revenue diversification, we have already, diversified the revenue, income from investment, other income, inflation rate. Government debt affordability. So when we talk about debt affordability, is it that we consider debt to reserve ratio? How if we consider debt to reserve ratio? Yeah, I mean, I'm coming to exchange fluctuations. Let us go one by one. Look at this PPT. Let us go one by one. So you can see there will be so many factors, so many parameters which will come into the picture. So many factors. Can I mention debt to reserve ratio? Yes, no. When I talk about debt affordability, debt to reserve ratio, we can, right? Next is interest payment coverage ratio. Right, interest payment coverage ratio. So reserve could be forex reserve, reserve could be gold reserve, reserve could be cash reserve, could be any reserve. And clubbing up all these reserve, you can say it's a reserve for the country. Right? Interest payment coverage ratio. Right? So when I talk about investments, Kunal, we are talking about income from investment. So one is income, which will come in the profit and loss account. Another is your reserve, which will come in the balance sheet. These two are different. So if you are looking at the third point, which is income from investment, it's an income. It's not the reserve. You got my point, right? Interest payment coverage ratio, fair enough. Right. Debt maturity profile are considered to evaluate and debt maturity profile. Now, debt maturity profile is what? How much debt is going to get matured in this financial year. So immediate. So you can say long-term debt and short-term debt, right? Can it be like this? All right. Next is historical performance, past defaults, repayment delays, restructuring. So when I say I will consider restructuring percentage in the entire banking sector, NPA percentage in the country, right? Next one is budget deficit. Budget deficit. Budget deficit means expense gap between revenue and expense, right? Yeah, so one is budget deficit, another is budget deficit as percentage of GDPs, right? India targets 4.1. Okay, thanks for the info. Next is revenue and expenditure composition. We have already considered this. Then tax revenue as a percentage of GDP. Now we know tax revenue. Now tax revenue as a percentage of GDP, right? As a percentage of GDP, right? It can come in the scale, right? So short-term debt is basically the debt which you have to repay in this financial year. So it's an immediate liability. It's an immediate liability which you need to clear off this year, right? Okay. Next is current account balance, is trade balance. So export import, difference between the export and import. So we are trying to create a scale, a model for sovereign rating, current account balance, difference between export and import, right? So let me save this data. Rating models, right? Foreign exchange reserves. So we have already mentioned reserves, right? So we have already mentioned. So one is income from investment, another is debt to reserve ratio. So debt to reserve ratio, before that, let us put it like that, that reserve. And long-term debt and short-term debt we had already mentioned, right? So reserves, it can include your forex reserve, it can include your cash reserve, any reserve, right? Next is capital adequacy ratio. obviously, acha, exchange rate stability, foreign exchange reserves. So Forex, if you want to keep separately as Forex, then obviously you can show Forex reserve. Next is exchange rate stability. How do I put this? Stability. How do I put exchange rate stability? I need an answer from you guys for this. No, that's not the answer. No, hedging is not the answer. I want to quantify exchange rate stability. How much is my exchange rate volatility or stability if I want to quantify? 10 years is a long time, Anand. 10 years is a long time. I need that specific term and I can really calculate it. I can really calculate it. Even in Excel, I can calculate it. I should be able to calculate it. No, I will not give you hint. I will definitely give you the answer, but let it come from you. I want the 17 people who are currently in the group to answer this. No, Manish, not a correct one. Question is, how do I quantify exchange rate volatility or stability? How do I quantify that? Because whatever I am writing now is the quantitative aspect, quantitative params, which will determine my sovereign rating. No, Anand, no. I want the method. How do I calculate? What is the method by which I can calculate and I can put a value here? I need a method. No, sir. No. Beginning and end will not show volatility. Suppose the beginning of the year and end of the year, both the rates are same. Then there is no volatility. No. So now let me put it like this. Let me put it like this. 2, 3, 4, 5, 6, 7, and this will go up to 30. What is PPP? What is PPP? No, no, not that. Not that. I am saying the method to calculate. Please understand. Say this is shallow. And now the rates are, say, for last 25 days. For an example, right? Right? Now I have data. So these are days. And this is my USD price. These are days and this is my USD price, right? How do I calculate variance? How do I calculate variance? The variance is the volatility, right? The variance is the volatility. Correct. Now your answer is correct. So now if I do like this, this is my variance. Yes or no? This is my variance. This is the standard deviation, right? So I put it here as, rather than stability, I will write it exchange rate volatility or variance, right? Am I correct or not? Am I correct or not? So if I am correct, 6.46 is my variance. What is the variance percentage? Slightly less than 10%. Even if I consider the minimum price, then slightly less than 10%. So 6.46 is my variance, right? So this is one important factor which I am going to put in here. Now, say 2020, 2021, 2022, and 2023. Now you put all this data in this scale. I'm not asking about the benchmark. These are open source available or what? This can be available in the open source, right? Right? These are all open source data. I can find out GDP growth rate for 2020, 2021, 22, 23. And I can put all this data, right? By the way, I think there are a few more parameters. Financial sector, overall NPA and capital adequacy ratio. Yes. NPA percentage, I have written already. Capital adequacy ratio. Sovereign credit spread, analyzing the yield between countries. Analyzing the yield spread between a country's sovereign bonds and benchmark bonds, such as US Treasury. Right? So you can write credit spread as well. Right? So now, can we find out all these figures from the open source? What is the inflation rate for 21, 22, 23? What is the current account deficit? What was the reserve? So probably most of the figures are available, right? Yes or no? Some needs to be derived. Most of it. Say if I asked for GDP growth rate, let us quickly have a look. GDP growth rate in India for 2020. Of India in 2020. Minus 6.6%. What is this here? 2020, oh, 3.74, 3.74%. So it was 3.74%, right? $3.74. For 2021, it was minus 6.6. Next is 2022 and 2023. %7.2%. No. It is 2.1%. (2023) 6%. Is it? One second. 2022 you are talking about, Praveen? 7.2%. Okay. Sorry. No. 7.2%. This is you are referring to, right? You are referring to 2022, right? Okay. Okay. Now let us have a look. 2023, if we get 6%, they say 6.7% is estimated. Okay, chalo, 6.7% I'm considering. 6.7, right? Now, once we consider this thing, we can easily plot it in a chart and see how the trend is. So this is the trend, right? Similar trend we can find out for any other parameters, be it tax revenue collected, other income, inflation rate, capital adequacy, and even say this is 6.46 is the exchange rate volatility. Say it is 7.2 for an example, arbitrary 7.2. This is 8.5, and say this is 9.2. Then the volatility is increasing. If I put this in the form of a chart, what do I get? The volatility is increasing, which is a negative, it's a red flag. That's okay, Kunal, just understand the concept. The figures can differ. That's fair enough. Understand the concept, right? So what we are trying to do, we are actually making a scale for sovereign rating. Then probably you get a total score. Total score. How do you calculate a total score? Probably you can give certain weights. Okay. And then probably you get into a total score, that how much weight you want to give for this factor. And probably you get into a total score like this, right? So you give a weight, weight, and you give a total score. Right? Similar thing, can we do it for the qualitative as well? But what is the challenge we face to do it for qualitative one? What is the challenge we face for doing a scoring for qualitative one? Correct. It is judgmental basis. It can include bias. Okay. Now coming to the qualitative factors. Yeah, it involves a lot of discussion, Praveen. I agree. But suppose this is quantitative, and this is qualitative. Now let us have a look on the points. When I talk about qualitative approach, institutional factors, now I say, yes, you are right. Suppose political systems, clear legal framework. I say the legal framework is clear. Praveen might disagree to that. Policy environment, monetary policy, fiscal policy are good. Yes, no. Now what happens in qualitative scorecard, that can be a binary one. This is a major problem. So what happens if I ask political framework is good, you can either apply yes or no. Now this reply will vary from a person to person, because this is influenced by my way of judging, my biasness, my inclination towards certain thoughts, certain factors, right? So that's why in sovereign rating, it is very difficult to bring qualitative parameters here. Am I correct? Now say social and demographic factors, education level. I can say the education level of say Kerala is very high. You can say that fair enough, education level of Kerala is very high, but then overall country's education level is low. There are states where probably 1% is educated, right? That can happen. Correct, Tanumay. On a scale, we can put number and probably we can go by the maximum audience's opinion. So suppose 80% of the audience is giving 8 out of 10 or 7 out of 10, probably we can consider this. So the question will be slightly different in this kind of situation. The question would be, how do you rate the political framework of the country? This can be one question, right? Similarly, how do you rate the policy and how do you rate the policy formulated by the government? Again, 1 to 10. Do you think the external shocks could be easily absorbed? How do you rate the social and demographic factors? How do you think the central bank is independent in executing a strategy? How do you rate the geopolitical scenario? Geopolitical. Now, this will not be directly coming here. What happens, I'll tell you. You will have to make a separate question here, like this. Now you get it for different years and you find out the average. This average is going to come here. Say average is 7 for this, 8 for this, 6 for this, 5 for this, 3 for this, 2 for this, right? Again, in another financial year, it is 9 for this, 4 for this, 5 for this, 6 for this, 3 for this, 2 for this, right? Then again, you show the trend analysis for each parameter. Like the way we have shown it in the quantitative approach, similar approach we can give here, right? Can't we? S6, 8, 7, 5, 6, 7, right? So when we talk about one particular parameter, that political framework of country, for the last 3 years, what is being rated by the citizens or by the respondents, probably I can put it in a chart and show it like this. But this is the rating. It had gone up, then it had gone down. Can I do that? Yes, no. Can I do this? Yes or no? So once you do this, you get a total trend analysis for the last 3-4 years, both in qualitative and quantitative terms, and which even you can use in predictive analysis. That probably this is the trend and this could be the outcome, or this could be the possible scenarios in the coming 2 financial years. Now, does this scale make sense to you? Does this model make sense to you guys? Hello. I don't know what Praveen will say. I don't know how this model is familiar to the model they are working for sovereign rating. I'm not sure. Thank you, Praveen. Probably in sovereign rating, in real life scenario, probably there are some other aspects which you cover, or probably there are certain other variables which we consider. Right? So guys, this much for today. Thank you so much. Any question, any suggestion, any advice? Anything from your side, anything for me? Thank you so much, Praveen. Thanks, Anand. Thanks, Kamlesh. Thank you, Praveen. Thanks, Manish. Thanks, guys. Wish you a very nice Sunday. Take care. Thank you so much. Thanks. Take care, guys. Bye. Bye.